Welcome to our Winning in Retirement Classroom session, our mid-year report. I'm Brian Akers, Certified Financial Planner and President of Akers Financial Group, and we welcome you to our mid-year report. Today we have Bernie McVey and we have Alex Monk to give the reports on our portfolios, the economy, the markets, even having some forward-looking thoughts, a lot of information. So hopefully you're ready for this today. For all those first-time people that are watching this, make sure we have your email address so we can send you a gift for just taking your time with us today. We thank you very much for taking this moment and enjoy our talk.
Hello, everyone. My name's Bernie McVey, and I'm an advisor here at Akers Financial. And we're here to discuss the second quarter kind of mid-year review on everything related to markets and your investing. So we've got a number of discussion topics today. We want to talk about the overall market, and that certainly will involve the geopolitics that's going on in the world that is influencing pretty much everything these days. We want to talk about what we see as changes that are occurring in the market that will influence what we want to do with our investments kind of going forward. We want to talk specifically about our AFG Select portfolios and talk about the performance there, and then also talk about the various strategies that those portfolios employ and the changes that we are making to try to take advantage of changing market conditions. And then we want to discuss kind of going forward the way we see the markets kind of going forward. And that's a bit of a crystal ball, but we've got some opinions on that we'd like to share with you. So off we go. So the geopolitics in the world today are quite interesting, and they're definitely influencing the market. There's lots of folks that are nervous because the markets are quite expensive, especially here in the US. We're coming off a year like we've never had previously with a pandemic. When we look at some of the comparables to last year, we're going to need to keep in mind that the markets were roiled this year, beginning in March, but into the second quarter before they actually began recovering. So we've got the specter of an ending pandemic, we hope. Of course, there's a variant that's kind of taking place and it's grabbing some attention in the market today, but it's got the China influences, the movements that are taking place around the world, kind of resisting a lot of the control that's been exerted. We've got a very accommodative Fed, which is really important to the market. So if you pay attention to what the Fed actually says and listen carefully, you can see that they really do intend in the near future to stay quite accommodative, which is actually good for the markets. From the government perspective, we've got an administration that is planning on spending a lot of money, and this has profound implications. First of all, the money will eventually flow down into the markets, and economic activity will pick up. Of course, the risk there is all of these new dollars that are entering the environment are going to create inflation. And we do expect that to pick up. We've already seen some of it. The Fed says that it's transitory, which means that it's temporary in nature. I'm not certain how we know that, because the dollars chasing scarce goods are what really drives inflation. And we're seeing some scarcity in supply chains now. We've already seen the microelectronic circuits kind of halting things and production of things like cars and appliances. We've seen a little bit of shortages in other areas of the economy. Food, for example, we've seen the cyber attacks on pipelines, on school systems, on food producers, and so on. So we're in a very volatile environment. So that is the one thing that you can expect is volatility. So with that, we believe that with that changing environment, we definitely believe hedging strategies are appropriate, and we'll talk about how we do that, and we recommend that you do that. We do it within our portfolios, and we're actually making some changes to them based on this new environment. Alex will go through those. So we'll go through the portfolios, and then we'll close with some forward-looking thoughts on where we think we may be heading from here. So what I'd like to do now is talk a little bit about the actual performance. We're going to start with the US markets and then go to Europe and Japan, the major Western markets. And then Alex is going to talk a little bit about the performance of some of our diversifying kinds of investments, the commodities, of course, real estate is a portion of that, and so on and so forth. So we'll go with that. The Dow for the year is up almost 29% year to date. I'm sorry, 13% year to date, but 29% over a 1-year period. So, despite the expensive nature of the market, we still can see that that it continues to move forward. Again, just a little bit of framing that is, we were kind of in the pandemic stages. There was a lot of uncertainty in the market at the end of the second quarter last year. So it had begun to recover a bit, but still the performance is really good. And if you are invested in stocks, and you are pleased that you were able to participate in some of that performance. Same kind of thing for the S&P 500, up dramatically over the course of a year, and really good performance kind of year to date. We do worry a little bit about, the sustainability long term of this kind of increase. We are kind of due for a correction, which is why we definitely believe in safe money and keeping your hedges in place. NASDAQ is where many of the technology stocks reside, and where, growth stocks, we really see their performance, and you can see the performance there is pretty dramatic. Internationally, just a word on international investing, just generally speaking, we definitely believe that a portion of your portfolio belongs in these markets. We're going to talk about the Western markets, Europe and Japan, and they have definitely lagged the US over a period of years. But there's a concept called reversion to the mean, which means eventually things correct. And that can correct by the US kind of coming back, or international markets exhibiting growth to kind of play a little bit of catch up. We never know exactly when that's going to occur. So we believe keeping a portion of your investments in these markets reduce risk. Yes, over any given period, it may reduce performance, but it definitely reduces the risk of your portfolio, which is of interest to our retirees and near retirees. So in Europe, you can see decent returns. I mean, the European stocks have actually come back a little bit. Yes, they are still lagging the US, but decent returns. A lot of quality companies in this European 50 stocks index, very high quality companies. And Europe has lagged us a bit in our recovery from the pandemic, but Europe is actually showing some signs of life. And then Japan, which has been, a laggard, if you will, over the last couple of decades, but still is a major economy, and one of the largest in the world. It's shown a 21% increase over the last year, but basically flat kind of year to date.
Hello, I'm Alex Monk, and I'm going to pick up here where Bernie left off and hit on some asset classes that are outside of your traditional US and international markets. And we're going to start with commodities and metals. So I'm sure everyone's felt it at the pump, but guess what? Oil is up, and it's up pretty dramatically. The demand went down significantly during COVID, and turns out people started to travel again, and the prices jumped, and they have gone up a lot. So we're almost 60% year over year, almost 40% just this year. And that's why we like to hold commodities, because when these things jump, they jump quickly and significantly. I don't see the demand for oil going down. A lot of people are still going to be traveling domestically. So it's a good portion to have in the portfolio because it performs differently and independently than other markets. Gold is kind of a funny one. You would think that with all the printing of money and the stimulus on the US dollar, that gold would actually be moving up in the trade. But year over year, it's about flat, down 1.7. And just this year, it's down almost 5%. And it's a strange movement. And I think a lot of it could be different functions in the market. It could be different hedges being used. There's also not a lot of reports on who owns what as far as countries owning gold anymore. So the gold trade's kind of one to watch. It's a good protection of your purchasing power, and it's a hard asset, so it's going to operate differently than your traditional stocks and bonds. And for us, we feel that gold really is a permanent position, one that gets sized up and down as we rebalance. But overall, we're going to want to own precious metals as a way to hedge against currency risk. So from there, we'll get into the US Treasuries, which dictates interest rates and also the strength of the US dollar. So the 10-year Treasury has gone up, meaning interest rates have risen. So they're still very low. That being said, they're up significantly from last year. So the Federal Reserve last year lowered rates in order to stimulate the economy. Now, when there's all this stimulus and all this money printing, the feds have to pay the interest payments on their debt. So there's most likely going to be a range that the 10-year can stay in. Because if it goes too high, then we won't be able to meet our obligations on our payments. So for a country, we have to manipulate that in order to meet our obligations, keep our credit ratings. But how that fits into your portfolio can be a little bit different. So when interest rates are low and money is cheap, then the place to go for returns is the stock market. You can either go dividends or growth, but typically you'll see the NASDAQ or tech stocks or growth stocks trading with an inverse correlation with interest rates. So the lower rates are, the more money that goes to the growth side. And it's a strange correlation in that you can't get the rate of return you need to keep up with inflation by holding these notes. So you have to go to risk assets. So we'll see a lot of swings in this 10-year as we go through reopening, we go through how are companies doing this year, but it's going to be in a range. So I don't expect rates to jump high quickly, and I expect them to be low for a relatively long period of time. The US dollar has been pretty stable throughout all of this. And that's an interesting result with all the stimulus and all the printing of money right now. So it's a little strange. relative to other currencies, the US dollar is still the strongest. That's a good thing for us as a country. We'll have to see how international currencies move and how that impacts trade and the value of the dollar. In theory, you would think that the dollar would be going down, but everyone in the world is printing money right now. So that strength in the US is also tied to the fact that it's used for a lot of payment systems, the SWIFT system, the oil market. So a lot of things that are traded are denominated in US dollars. And right now, that's really the kind of that anchor that keeps the value of the dollar up. If international markets and their currencies start to pick up and do better, or there's other things denominated in their currency, we may have some dollar strength risk. But really, the main thing with the dollar is not how it's moving up and down, but what has happened to our purchasing power. And that's really why we want to watch inflation and see what portfolio changes and moves do we need to make in order to keep up with inflation and protect our purchasing power. Because, like it or not, living in the US, you use the US dollar to buy, sell, etc. All right, so now let's get into the portfolios that we here at Akers manage through a company called Brookstone Management, which a lot of you may have some or something from Brookstone already. And these models are ran in-house by our investment committee, headed up by Bernie McVey and myself. So we'll just get into those models and see how things are going. All right, so here are our AFG Select models. We have a growth in income, which focuses on current yield, current income, as well as longer term capital appreciation through quality equities. And from there we go to our moderate, which has similar focuses. It has more diversification because we're looking for, kind of moderate or moderate aggressive to be our core. And that core is where we can build things around it. We'll get into that a little bit later. So moderate and moderate aggressive are both active management, passive management mixes. They have commodities, they have technology overweights, they're globally diversified, well-rounded. And then on the far side, we have the diversifier. So the diversifier is our portfolio that's used in addition to one of our core portfolios. And the theory there is to get the exposure that we need to all of those alternative asset classes to round out the overall portfolio allocation. Because remember, we don't want to try to time the market. We want to pick our allocation and stick to it. We rebalance to it along the way, but our goal is not to time the market. It's to set allocation models using the best funds available to achieve that goal. All right, so some of the recent changes that we've made this year, just to update everybody on what's actually been taking place. In April, we rebalanced. So when we rebalance, we go back in and everything gets trued up to the model, meaning any asset classes or funds that have ran up will get sold down to their portfolio position size, and anything that's gone down will get added to. So what that does is it takes advantage of some of our profits and it protects them, and then it takes those profits or things that have run up and puts them in asset classes that have underperformed, in the theory that we will do better buying things low and selling them high. We chose April because of the way the tech market was and the way the overall stock market was trading. It turned out to be a good time to rebalance. But again, we're not trying to time the market. We are looking to set our allocations and make sure that we stay on track. Here in this upcoming month, July, we are changing our overweight allocations to iPay. So we're adding a moderate portfolio iPay position, and we are adding to the iPay position in the moderate aggressive. The theories there are there's a lot of things changing in how finance is done, whether it's mobile payments, online payments, all of these transactions. So iPay takes advantage of companies that are on the forefront of the new digital payment or um, crypto, if you will, but the technology and the processing behind that. There's a lot of underbanked countries out there, and these companies will serve as their non-traditional banks in the future, we feel, as technology picks up, as third world and underdeveloped countries switch to digital currencies, or they have a stronger infrastructure for internet and things like that. And as we've been talking about along the way, inflation is definitely on everyone's hot button. So how are we trying to hedge against inflation? We're using shareholder yield. So when interest rates are low, companies have a lot of access to cash and they're buying back stock. So stock buybacks gives an appreciation in price to the owners. We also focus on debt reduction. So if they are reducing their debt, that's going to reflect in higher share prices, higher dividends. Dividends are another thing. As inflation picks up, stocks will go up as they're denominated in earnings or dollars. So those dividends will increase, and that will help us keep up with the price of goods increasing through the participation in the profits of those companies. The other asset classes we use are metals and commodities, as in pandemics and weird transitory economies, different natural resources, metals tend to jump as they're either scarce or there's fear or there's currency issues. And then from there, diversification. We don't know what asset class is going to take off next, but we need to know what's our risk reward on having certain amounts or percentages of all these asset classes in our portfolio. So it'll help us beat inflation or keep up with it, and it will also smooth out the volatility of our overall returns as the market swings up and down. And we've been seeing it a lot. We're expecting that going forward. We're going to see a lot of things we haven't seen in ever before in our history. So the market's going to be volatile as it digests these things and gets used to the new normal, if you will. Now that I've covered the changes, Bernie and I are going to go over some different types of things we're looking at as far as trends and different things in the market we see, as well as what we expect going forward. So what we have here is a chart that shows value versus growth. So the chart here shows where the value index is as an average and where the growth index is. And if you look at what companies are expensive right now, the growth names are still more expensive. They have a much higher price to earnings ratio. Now, if we look at the chart on our right, SYLD, one of the funds we have in our models, has an average price to earnings of about 16 versus the S&P that's almost 30, which the S&P is a little tech heavy, and the mid cap value category, which is about 20. So there's still places to find value in the market. We need to have growth so we can pick up in the runs and the new upcoming companies, but value is still out there. And one of the ways a shareholder yield does this is through looking for companies with strong dividends, buybacks, and debt reduction. And Bernie's going to kind of cover what buybacks mean, because a lot of people hear that in the news, and I'm not sure everyone understands what that actually does.
Yeah, buybacks are simply when a company has its board authorize the repurchase of outstanding shares. So essentially what happened is you're reducing the breadth of the ownership of the company, which makes all the remaining shares more valuable. And the reason you want to invest in companies that are doing buybacks, it's basically a tax-free way of enhancing your value because there's no transaction that's taxable and all of that, right? You continue to hold the shares, there's fewer of them, same earnings, you get a bigger piece of the pie. So that's what discriminates a shareholder yield type situation from a pure dividend play. That and the fact that they are actually actively reducing their debt, which again makes the equity shares more valuable.
Right, and if you're buying back shares, you gotta have cash. That means you got good earnings, you're a solid company. Whereas a lot of the tech companies, they go to the market to raise capital. And it's kind of a, let's see if this works out scenario versus a company that's being conservative and reducing debt and increasing cash flow, because cash flow is king.
Cash flow is king. So all this leads to, so we've talked about where we are in the market today, but the forward-looking thoughts are of interest, we think, to you as well. And Alex and I, on behalf of Akers, really do agree with these thoughts. First one is expect volatility, right? The market's very expensive right now, okay, especially here in the US. We've already showed you that it's cheaper elsewhere, and then there are pockets where you can find value here in the US as well, but it's very expensive. And so if an expectation is missed, the stock is likely to be hammered. It's really at an all-time high now. It's really being fueled by all of the money printing and the government spending that we talked about earlier in the presentation. And so longer term expectations probably should be a little bit more muted. You're not going to see the average, 15% annual return that stocks have shown, in the recent long-term past. So, expectations need to be somewhat muted.
Right. Especially with things being around all-time highs, eventually things revert back to the mean. So if we look at long-term averages on the market, and over the last 10 years, you've averaged 15%, the long-term return average is 8%. How do you get there? You got to have some down years. So there will be volatility to come.
Right. So the new occurrence here in the market here in the second quarter is the evidence of inflation, right? We've seen a significant uptick in inflation. Previously in 20 and previously, the Fed had targeted 2% as kind of its annual target rate. It never really was able to achieve that. And now here we're trotting along at an average rate over 5. And that was a really sudden jump. And that has some pretty profound implications for your wealth, especially if you're on a fixed income or nearing retirement. And if that continues for any given period of time, you can see some serious purchasing power erosion. So, we have some thoughts about portfolio changes that we are incorporating that will help to deal with that. But simply stated, we think hedges, commodities, and international are 3 interesting ways to, hedge the erosion of purchasing power here in the US. And then obviously, even though stocks don't necessarily like inflation, they are the long-term answer toward how you beat inflation.
Right. So
the equity side.
If these companies are functioning on the US dollar, meaning that's what their earnings are in, and everything's going up, then the value of the stocks, it all floats upward. Now, it's not a real gain because of your purchasing power decreasing, but the numbers keep up, I guess would be a good way to put it.
Especially those stocks that have purchasing power, the ability to pass along pricing power, price increases to consumers. We also think, watch the Fed kind of going forward. They tend to signal their thoughts and how they're going to react to occurrences in the market. Right now, they've signaled they're going to continue to be accommodative for the near-term future. A lot of people call that the Fed put, meaning that there's a floor under stocks. I don't know if I would go quite that far, but they definitely have major influence on the market, and they're worth paying attention to. So we listen.
And they're going to broadcast these things when they're going to start raising rates. We'll know. I mean, we're going to know months and months in advance. We need them to raise rates eventually so that they do have some type of power to step in. Because right now, they don't have a whole lot of tools left in their toolbox to prop said market up. So once we get back to that normal functioning thing, we expect rates to rise. I mean, not too high because of the level of debt and the payments that have to be serviced on that, but the Fed will tell us how they're going to act in certain situations.
And then, of course, we believe in having a portion of your money kept in safe kinds of investments. And that will help you to offset any major corrections in the portfolio. It'll give you some options should you choose to invest in that type of situation if there was a big turn down in the market. And we think that's a really important part, even though we're entering an inflationary environment, to keep some of your savings liquid.
Right. So we got to have your liquid money, and then we want to have our protected money. But really the big key is, and the thing, the service we provide to our clients is overall asset allocation that fits each person. So we want to make sure that your asset allocation is right for whatever your goals are, whatever you're trying to achieve, because it's not going to be the same. And that's why we have multiple portfolio models, but also we use these as a core and we build out around them so that we can make sure people get the diversification. And we always want to keep meeting and talking to you so that we can rebalance if we have to. We need to keep meeting to make sure no one asset class gets out of whack and that we're able to handle whatever the market comes, whatever it throws at us, because we don't know. And last year was a great example.
Last year is a great example. And everyone's risk tolerance is different, and we need to design your own portfolio around a risk tolerance level that you're comfortable with.
Yeah.
So we think we can really help you with that.
And if you guys have any more questions, feel free to email me or Bernie. We're happy to talk to anyone or walk you through anything that doesn't really make sense.
All right, well, thank you very much, Bernie McVey and Alex Monk. This mid-year review is part of Akers Financial Group, and we want to make sure you guys get as good information, updated information. You can also follow us on our radio show on Saturday mornings at 11 a.m. at 105.7 The Fan. Our website, akersfinancial.com. If you go to akersfinancial.com, you can basically see the webinars we have now and the ones that we produced throughout this year. We also have a radio show tab, which will give you the past radio shows, depending on what topics you're looking for. We think there's a lot of great information there. So this mid-year review basically sort of says where we are at the moment, and we got a lot of things to think about and look forward to this fall. We've really got to make sure your financial planning is built for you and your risk tolerance. Make sure that this plan is your plan, and make sure we are doing everything we can to help you with your goals. All right, Kim Hake gave me a list of things to do I need to read, so I'm going to make sure I quote these to you, okay? All right, if you're a first-time watcher, make sure we have your information so that she can send you gifts that she has. She has a few gifts that are very nice, and they'll be coming your way. Also, instead of webinars for the fall, we are actually going to have a retirement expo. Yes, September the 10th at Waters Edge Event Center in Bell Camp, Maryland. That's going to start around noon. We'll have our opening at 1 o'clock. It'll be the first class. Don't come before noon, come afternoon. And then the afternoon will be full of classes. We're going to try to do what we used to do just a couple of years ago. And then we'll finish the night with some food at the end and a final goodbye. It's a big day planned. Kim Hate's working very hard with all of our speakers coming in. So we look forward to that day. September the 10th, Friday at noon is when people can start arriving. And the first class will be at 1 o'clock at Waters Edge Event Center in Bell Camp, Maryland. All right, if you have any questions on what we're covering today, or any questions at all, feel free to give us a call at Akers Financial. We look forward to speaking with you in the future. Thank you for everything and have a good day.